Hello to everybody. I'm Nicolas Bornozis of Capital Link, and I would like to welcome you to today's Trending News webinar series. It is our pleasure to welcome Mr. Peter Zacho, the CEO of Navigator Gas. Navigator Gas is the owner and operator of the world's largest fleet of handysize liquefied gas carriers and a global leader in the seaborne transportation services of petrochemical gases such as ethylene and ethane, liquefied petroleum gas, LPG, and ammonia. The company's fleet consists of 59 semi or fully refrigerated liquefied gas carriers, 28 of which are ethylene and ethane capable. Also, Navigator owns a 50% share through a joint venture in an ethylene export marine terminal at Morgan's Point, Texas, on the Houston Ship Channel in the United States. And Navigator Gas's stock trades on the New York Stock Exchange under the ticker symbol NVGS. Now, before we begin, please note that this discussion is for informational and educational purposes only. It should not be considered as an investment advice or an offer to buy or sell securities or advice of any kind. And of course, Capital Link bears no responsibility for its content. And as a further disclosure, we have the privilege to work with Navigator Gas on investor relations. And now let me welcome Max. Thank you for joining us today. We look forward to your insights on market trends, on Navigator strategy, fleet operations, growth plans, as well as your financial outlook for the company. And my first question would be, what specific levers are you focusing on to further enhance profitability going forward?
Thanks a lot, Nicolas. It's a pleasure to be here, and thanks for the question here. When we look at our business, it's really about driving, you could say, the top line. It's about managing costs well, and then, of course, also ensuring that operationally it's running as a well-oiled machine. When it comes to operating costs, I think over the past 5-7 years, we've managed to keep our costs in check. Overall costs have only increased by a low single-digit percentage point cost increase. And if you compare to the US CPI, it's up maybe 20% over the past 5 years or so. So in real terms, we've managed to gradually reduce cost over time. And then at the same time, we have been driving up our revenues through time charter equivalent rates. If we look back 5, 6, 7 years, our profitability was not very impressive at all. I mean, we were barely breaking even. We were running cost at $1 per day of around 20,000, and we were generating also just over $20,000 per day. Now it's a different picture. We managed to bring up rates up to 29,000 in round numbers and still have a cost base around $21,000. So a nice free cash flow wedge between cost and revenue. And it's really, for us, very important to continue to drive up rates because our customers can also see our profit and loss statement and see that our return on equity is barely around 7% right now, and that's not good enough for our shareholders. We need to continue driving up profitability, and it has to be through higher rates.
So, given your profitability levels, let me ask you, what is your capital allocation going to look like going forward? You have a cash position of $140 million at year end. At least 25% of the fourth quarter net income was returned to shareholders via dividends and buybacks. So how are you balancing priorities for capital allocation going forward?
Yeah, and if we start with a cash position for about 140 million, it looks like it's down. It's down compared to the year before, but you need to keep in mind here that we paid $130 million for the terminal expansion at Morgan's Point, and we also paid installments to the mid-size gas carriers that we ordered during last year, and we also significantly paid off our debts during the year. So quite significant capex and debt reduction at the same time, which is why the 140 million is actually a great achievement and basis good cash generation during the year. If we look at how we distribute the cash, we have a capital return policy right now where 25% of our net income is distributed to shareholders by share buybacks and by a fixed dividend of 5 cents per share. It is definitely something we will continue with, and we've also gotten the input from a number of shareholders that they think we should look at increasing it. We did some large share buybacks last year and the year before, $50 million each year, or about a 5% yield from just those ad hoc buybacks. And we think that has worked really well for us, and this is something that we would like to continue doing. So I think more cash to shareholders going forward than we've done in the past. And I think also when it comes to investments, I think we did quite an ambitious program last year, and I wouldn't be surprised if we were not as ambitious in terms of acquiring new capacity this year.
In a way, you kind of answered my next question, that given the high new build costs and yard constraints, if you continue to looking for further growth, are you going to look more towards second-hand vessels instead?
Yeah. I think if we look at the new build market, we ordered 4 vessels last year. We're very pleased with that. And I think I would be a little bit hesitant, you could say, in putting in more new building orders, also in the geopolitical environment that we are in right now. Secondhand, we bought 3 secondhand vessels around New Year. We bought them at very attractive prices, and they fit really well into the expanded capacity at Morgan's Point. They are ethylene capable, and they can take up and do this additional transport of ethylene that will come out of the terminal over the next couple of years. So there will maybe opportunistic opportunities coming in over the next few years, and of course we will look at those, and particularly if the price is really good. Consolidation opportunities is always at the core of our business, our strategy in the handysize and mid-size ethylene segment. So I wouldn't rule it out, but I think capital return is probably higher priority in the short term.
Also, you've been very active in terms of new business development in several areas. So I would like to ask you, are you looking to expand into any new gas transport segments or pursue any additional joint ventures?
We have a couple of great joint ventures that we established during the past year or two. I mean, we've invested a small amount of capital into 208 for clean ammonia production in Texas. We've also invested into ethane fuel solutions, building out the infrastructure for ammonia bunkering for vessels. And then we also have Blue Streak, our CO2 transportation joint venture. So those are doing well. They're developing, and we want to see them succeed. We don't have, you could say, additional joint ventures in the pipeline just now, but we are open for opportunities. But I want to make it very clear here that we want to be pioneers in the energy transition, but we're not going to do anything silly. We follow our customers, we follow the market, and I think we've seen over the past couple of quarters that this green transition has slowed down a little bit, and that means that we are looking at how the market develops before we take any big steps.
Mads, we're currently navigating through a period of, I would say, unprecedented volatility and uncertainty. So what external market conditions could have the biggest impact on your future earnings outlook?
Yeah, I think probably right now it's the geopolitics. I mean, you can hardly open your news app in the morning without there being a big new announcement coming out from the US administration, and some of them affect shipping. So we are of course following this very carefully, including what's happening with the port tariffs for Chinese-built vessels, etc. So I think the trade friction that we are seeing, the risk of tariffs and so on is something that we're following very carefully. I think that's probably the biggest joker right now, and it seems to be a very dynamic environment that we are navigating right now. I think when it comes to the market in general, in the US, the production of natural gas liquids has grown very robustly over the past many years, and we expect them continuing doing so. It's a strategic priority for the US to export cheap, large volumes of energy, and we are there to transport it. So I don't think that from a supply side that there's if you abstract from the geopolitics part of it. So I think that we're looking into a good robust market, and I think also with the financial robustness that we have right now with modest debt and with good interest hedging and so on, I don't see that there are big risks coming from that side.
Now let's move on to your fleet operations and growth strategy. Recently, you completed the acquisition of 3 handysize ethylene carriers. How do these new vessels fit into your fleet deployment strategy, and what impact do you expect them to have on your earnings and markets?
No, I think they're really hand in glove acquisition here, because it is a consolidation of the handysize segment, and this is something that we communicated for a long time that we would be interested in taking part in. Secondly, they are here right now. They are already laden now, and they are transporting petrochemical gases for our customers just a couple of days after we took them over. So they're generating earnings right now, and they're transporting product out of Morgan's Point right now. So they're filling the void, you could say, between now and the time when our mid-sizes will be delivered in 27, 28 onwards. So I'm very pleased with that acquisition. And they'll be, you could say, 3 vessels. That's about 5% of our fleet by vessel count. So you can, and they are pretty average, you could say, in earnings capability. So you can add 5% to our EBITDA from those.
Now, let me move to the next question. What operational efficiency initiatives are you implementing to further reduce costs and improve performance across the fleet? Is there further room to push operating costs down without sacrificing service quality? Just to remind our listeners that your OPEX is about 9,000 per day, and your cash break-even is about 20,600 per day.
Yeah, I mean, if we look at the efficiencies first, energy efficiency is a big thing, not only because we want to reduce emissions from our fleet, but also because we want to save dollars from the fuel bill. And we have, over the past year and a half, been investing into 12 technologies that we've implemented across the fleet. In all dry dockings, in all opportunities we've had, we've installed the likes of anti-fouling paint, hull paint, bus cap fins. We have propeller cleaning devices set up, frequency converter, lots of widgets, you could say, that we have invested onto the ship to make them more fuel efficient. And then also worked on the soft side, you could say, with training of our staff, but also implementing softwares for, like, say, trim optimization or sensors or analyzing the data we are getting from our sensors. So a lot of investment going into fuel efficiency, and that's a really important one. And then back to where I started by saying, keeping the overall operating cost in check and keeping them low in nominal terms, that will continue to drive, you could say, profitability forward as well.
Thank you. Now let's move on to the closing segment of our discussion on market trends and strategy.
Yeah.
The petrochemical gas shipping market is currently outperforming the broader LPG shipping segment. So how is Navigator leveraging these favorable niche trends globally, and are you focusing on certain routes or cargo types to maximize this advantage?
I think one of the strengths of Navigator is that we can transport a number of different cargo types between the LPG, the ammonia, the petrochemicals, ethylene, ethane, and so on, and switching between them. When one market is strong, this is where we deploy our fleet, and if it's weak, we exit it. So we can move between, and I think that's one of the keys in maintaining, you could say, a robust profitability over time. We're not, you could say, favoring any global routes per se. We like long haul. A lot of our transportation would be ethylene and ethane out of Morgan's Point from Texas and to Asia and also to Europe. I think that's where we have the competitive strength to go across the major oceans. But we are a global operator, and we will deploy our fleet where we see the best profitability.
Now, let me move on to the ethylene transport. Ethylene transport demand was temporarily softer in the fourth quarter of 24 and into the first quarter of 25 due to US cracker maintenance and turnarounds. How is Navigator adjusting its strategy and fleet employment during this dip in demand? And what is your plan to capitalize on the rebound as arbitrage opportunities improve and petrochemical volumes pick up?
Yeah, no, it's true that we did see the arbitrage narrow over winter here, mainly because the US prices for ethylene went up with the cracker turnarounds. We're seeing it widening again now. It's normalizing, getting back to to a level where transportation across both the Atlantic and the Pacific is getting feasible. So we see a normalization here. Over the past half year or so, a significant part of our fleet has, instead of transporting ethylene, transported ethane, and we've seen the same good rates from doing so. So it has meant that the throughput at the terminal has been lower than the capacity, but you could say on the shipping side, it hasn't really impacted us much because we've just transported ethane instead. And that's again back to what I said with the balancing and us being able to service the markets where we see the strongest demand and the strongest rate. So we'll continue to do that, but we do have expectations that both ethane and ethylene will continue growing out of the US, and there'll be plenty of demand.
Matt, let me go back to the point that we touched earlier, geopolitics. That's a critical factor today. Now, geopolitical tensions in regions like the Red Sea and Black Sea, the Ukraine conflict, have disrupted trade flows. We also have the new US administration broader policies. So what impact do these have on your shipping operations or cargo flows? And how are you managing or hedging against such geopolitical risks in your strategic planning? I know that's not an easy question to ask.
Oh, but I think remaining flexible, staying close to the customers, and ensuring that you have a fleet that can service both different geographies and different cargo types and so on, so that if there's trouble one place, you have the opportunity for going elsewhere. But I think the important thing here is that when we see those conflicts flare up around the world, what quite often happens is that transportation demand increases simply because the optimized global supply chain is being disrupted, and that means that cargo flows will change characteristics, and that means often that it'll, instead of being optimized, it will be inefficient, but that means more ton miles to be transported. So often shipping tends to be, you could say, benefiting from these disruptions, as sad as they are, and we saw that with the ammonia flows, for instance, that suddenly had to be sourced to Europe from faraway places when they no longer came from Ukraine and Russia a few years back. So we'll have a normalization in the Red Sea, hopefully soon. That would mean for the container lines and others shorter transport distances, but for our ships, we don't go much through the Red Sea anyway, and so there'll not be any effect from that.
Now, the last question to ask you, Matt, are you observing any shifts in customer requirements or preferences in the liquefied gas market? And if you have any other comments for closing our discussion?
I think we do see that the cargo owners we're interacting a little bit more with the cargo owners and perhaps a little bit less with the traders. I think we have very long-standing, strong connections with the cargo owners, and we deal directly with them. I think other than that, many of our customers are quite happy with having relatively short-term commitments with us. We do keep, you could say, a trading book where we have maybe about 40-45% of the next 12 months days fixed, and we think that's a good sweet spot. We don't necessarily look for having long charters. We have a robust balance sheet, so we can afford ourselves to have the operational risk of doing spot business. We think spot business is where we make the most money, and that's also why I think I just want to make a point out of the utilization that we've been running around 90-92% utilization. We could increase that to 100% if we put all our ships out on time charter, but that wouldn't necessarily be a good thing for our shareholders. We think it's much better that we have the in-house capability to optimize the earnings by sometimes being short, sometimes being a little bit longer, and really managing those positions. So we do that constantly, and we optimize it, and therefore we find the right mix, long, short, and the length of the charters.
Matt, thank you very much for sharing your great insight with us today. It has been a pleasure discussing Navigator's market strategy, fleet operations, financial outlook, as well as the sector outlook for the petrochemical gases. So thank you very much for joining our discussion. Now, as a closing, for those who would like to revisit this conversation, the interview will be available on demand on our website at www.capitallinkwebinars.com, and of course on Capital Link's YouTube channel. And I'd like to thank Matt and of course all of you for joining us today. We look forward to having you with us at the next discussion.
Thanks a lot, Nicolas. Have a nice day.
You too.